Imagine a company whose entire future hinges on this uh, really high-stakes bet, pioneering the next generation of warfare with unmanned systems. But is it a brilliant strategic move? Something that will redefine national security? Or is this small-cap player flying, a bit too close to the sun, risking a spectacular fall? Today we're diving deep into RCAT Holdings, ticker symbol RCS. And trust us, the story is, well, anything but clear-cut. Welcome to the Deep Dive. Our mission today is to cut through the noise, unpack the intense debate around RCAT. This isn't just any company. It's a pure-play defense tech provider making serious waves in the unmanned systems space. And its journey, it's a fascinating case study in ambition meeting, well, extreme risk.
Exactly. And we'll be exploring its business model, its leadership, financials, market position, and yeah, the inherent risks. All based on a comprehensive stock research protocol from the Stock Analytics and Industry Research Desk. Our goal is to give you a dispassionate look at the facts as of September 12, 2025, when RCAT closed at $11 per share.
And this deep dive, like many others, is powered by the incredible insights from Stock Analytics AI. If you want priority access to deep dives on specific tickers, plus coverage of all S&P 500 stocks over the next few months, become a member. It's just €4.99 a month. Or, for a one-off deep dive, just drop us a super size. Thanks. Okay, let's get into it.
The core foundation.
Ticking things off, let's go straight to their foundational shift.
Right. And that brings us to Chapter 1, the business of unmanned systems.
So RCAT Holdings, they've undergone this really dramatic transformation, moving from consumer drones, focusing entirely on defense tech.
Yeah.
That's a massive pivot. Is this truly a sustainable long-term strategy? Or are they just, chasing the latest trend? What are the core components of this new defense-focused business model they're banking on?
It's definitely a high-stakes pivot, yeah. They fully divested their consumer interests back in early 2024. The focus now is entirely on military, government, and public safety. Their revenue comes primarily from selling integrated unmanned systems, so that's both the cutting-edge hardware and the intelligence software that makes it work. What's fascinating here, though, is their long-term model. They're anticipating recurring revenue streams from maintenance, support, training. That could potentially increase the lifetime value of these contracts by, 50–70%. So it isn't just about selling a drone, it's about becoming an indispensable partner, creating a much more stable financial foundation down the line if they can execute.
Okay, so integrated solutions, not just drones off the shelf. What exactly are they building then? The source mentions an integrated family of systems, air, land, and sea. Tell us about the stars of this pretty ambitious lineup.
Well, the cornerstone is Teal Drones, which they acquired back in 2021. Its flagship product, the Black Widow drone, that's an evolution of the Teal 2, it actually won the crucial U.S. Army's Short-Range Reconnaissance, or SRR, Program of Record contract. Okay.
Its specialty, they call it Dominate the Night.
Yeah.
Superior nighttime operations. And critically, it's fully NDAA compliant. That's absolutely vital if you want to supply the U.S. military.
You're right.
Then there's FlightWave Aerospace, picked up in 2024. That adds the Edge 130, which is a fixed-wing VTOL vertical takeoff and landing for longer surveillance missions. And their newest, probably most ambitious move, Blue Ops, Inc., launched just last month, August 2025. That focuses on unmanned surface vessels, USVs, so moving them squarely into the sea domain. They even have future products planned, like the Trichon, another extended-range VTOL, and Fang, which is a precision strike FPV drone.
Oh.
The idea is to complete a true sensor-to-shooter kill chain. It's an incredibly broad portfolio for a company their size.
Yeah, that sounds like a lot, spanning air and sea. But, given the sheer scale of the defense industry, are these innovations enough to really make a splash? How does a small player like RCAT carve out a niche, let alone stand out, against the industry's titans? Like AeroVironment? That's the critical question, absolutely. RCAT is a small-cap company, market cap around $1.1 billion. They're competing against giants like AeroVironment and also well-funded private players like Skydio.
Right.
Yet winning that SRR contract against those rivals, that isn't just validation, it's a strategic coup. For a small cap like RCAT to snatch this from established giants, it signals, well, a genuine technological edge the Pentagon is willing to bet on. It fundamentally shifted their market position overnight. Their value proposition is pretty clear: secure, U.S. manufactured, NDAA-compliant systems offering critical situational awareness. The key differentiator is that dominate the night capability in offering low-cost, portable, and crucially, attritable drones.
Attritable, meaning?
Meaning cheap enough that the military can afford to lose them in combat. Think of it like a chess game where you're willing to sacrifice a pawn to win the queen.
Okay, gotcha.
This isn't just about cost savings, it's a fundamental shift in military strategy. And it perfectly aligns Red Cat with the Pentagon's Replicator initiative, the idea of overwhelming adversaries with sheer numbers. It makes their tech less a luxury, more a necessity.
Okay, so they've carved out that niche. Let's zoom out a bit. What are the macro forces, the big market trends that could, either propel Red Cat forward or maybe crush it? And who are their biggest adversaries on this unfolding battlefield?
Well, they're right at the nexus of two booming markets. You've got military drones, over $40 billion in 2024, projected to hit $87 billion by 2030. That's growing at nearly 14% a year.
Wow.
And then the commercial drone market, projected to grow from about $17 billion this year, 2025, to over $65 billion by 2032. That's almost 21% growth per year.
Huge numbers.
Yeah. Key drivers are things like AI and autonomy, surging demand for ISR intelligence, surveillance, reconnaissance, and just the strategic shift by militaries everywhere towards unmanned systems. Competition, as we said, is fierce, AeroVironment, Skydio. But a huge opportunity and a really critical dynamic is the geopolitical tension with China.
Right, the DJI situation.
Exactly. A potential ban on Chinese-made DJI drones could create this protected domestic market for NDAA-compliant U.S. manufacturers, like Red Cat. We're talking a multi-billion-dollar vacuum just waiting to be filled.
Regulations can often be a hurdle for companies, right?
Right.
But for Red Cat, it actually sounds like they might be a powerful tailwind. Is that fair?
Precisely. The National Defense Authorization Act, the NDAA, is crucial here. It effectively bars Chinese drones from DoD procurement, creates that protected market. Plus, the FAA's proposed rule just last month, August 2025, to normalize beyond visual line of sight BVLOS operations. That could unlock immense commercial drone potential, a clear pathway for advanced stuff. Barriers to entry are high, though. You need stringent DoD certifications, advanced tech, and critically, inclusion on the Pentagon's Blue UAS cleared list.
Ah, the Blue UAS list.
Yeah, which Red Cat's drones are on. Think of it like the military's exclusive club for trusted drone suppliers. If you're not on it, you're basically not playing in the big leagues. It's a massive barrier that gives companies like Red Cat a huge competitive moat.
Okay, so putting all these factors together, the tech, the market, the regulations,
Yeah.
what's their secret sauce? What really gives Red Cat a sustainable edge in such a competitive, high-stakes market?
Well, while the Red Cat corporate brand itself is still kind of new to defense, Teal Drones is now basically synonymous with the Army's SRR program, the short-range reconnaissance. That's a huge credibility booster, something that would normally take years to build. And this was amplified just this month, September 2025, when the Black Widow got added to the NATO Support and Procurement Agency NSPA catalog. That opens up international sales channels, acts as a seal of approval for 32 member nations.
Big deal.
Huge deal. They don't have economies of scale yet, obviously, but their agility and that a tradable product design fits perfectly with Pentagon strategy. And crucially, getting program of record status with the Army. That isn't just a contract win, it's a deep embedding into the military's long-term budget. It essentially means the Army is building its future plans around their drone. That creates powerful switching costs, makes it incredibly hard for rivals to just come in and displace them.
Interesting.
So they're unique assets, secure, U.S.-made, NDAA-compliant supply chain, being a Blue UAS player, a strategic tech partnership with Palantir PLTR for AI-powered navigation when GPS is denied.
Which is critical these days.
Yeah, absolutely critical. Means their drones can navigate autonomously even if GPS signals are jammed or unavailable. And, of course, the ultimate third-party validation, that sole source U.S. Army SRR contract. That's the real kicker.
Okay, moving from their pretty impressive technology and market positioning, let's turn to the people steering this ambitious ship.
Right, which brings us to Chapter 2, Management Evaluation.
A company is only as good as its leaders, right? Especially in such a volatile space. What's the story with Red Cat's management team? Are they the right people to guide this company through its rapid expansion and numerous challenges?
The team is, well, it's a deliberate mix. You've got Jeffrey M. Thompson, CEO since 2019. He's a serial entrepreneur, experienced in scaling tech companies, has that capital markets experience you need to fund growth.
Okay.
Then there's Jeffrey Hitchcock, the CRO. He's a 22-year U.S. Air Force veteran, former AeroVironment exec, brings deep defense insider knowledge, invaluable credibility.
It's like a good combo.
It does, on paper. However, this leadership is currently being seriously tested. There's a class action lawsuit and a detailed short seller report out there. Both allege false and misleading statements about production capacity, about contract value. Their response to this crisis, it's a defining moment for their tenure, for their reputation.
Oof.
Yeah. For a company banking so much on trust, especially with the military, this is a significant hurdle.
Transparency is absolutely key for investors, as you said, but it sounds like there are some serious questions here now. And how are they actually spending money to fuel this ambitious, growth at all costs strategy?
Well, management has offered bullish revenue guidance, but the lawsuit directly challenges those past communications. It creates a credibility gap they really have to work hard to close. Plus, the departure of key executives like George Manassas, well, that raises concerns about stability just when they need it most during this crucial growth phase.
Not ideal.
Not ideal at all. For capital allocation, it's all about aggressive growth, funded entirely by external capital. They have what they call a disciplined acquisition strategy, buying Fat Shark, Skypersonic, Teal, FlightWave to pay for it. They've relied heavily on equity markets, including a recent $30 million raise. As a high-growth, pre-profitability company, no dividends, no buybacks, the focus is purely on growth, and that has led to significant shareholder dilution. Lots of new shares hitting the market.
So pouring money into acquisitions,
Yeah.
R&D, but are these investments actually paying off yet? What's their return on invested capital looking like, ROIC?
Right now, it's deeply negative, around minus 39.40% on a trailing 12-month basis.
Minus 39, wow.
Yeah. Now, that's not entirely unusual for a company at this stage, heavy R&D, scaling up, building for future contracts. But the entire investment thesis hinges on whether today's substantial capital spending will translate into high, sustainable returns down the road. It's very much a deferred gratification play.
Okay, that paints a clear picture of their operational strategy. Let's move to the bedrock of any company, its finances.
And that takes us to Chapter 3, Financial Analysis.
Let's talk numbers. What's their financial snapshot look like today, especially given these ambitious plans and, well, the spending?
Okay, so as of September 12, 2025, market cap is about $1.1 billion. Shares are at $11. Revenue growth has been rapid, but inconsistent, largely driven by those acquisitions we mentioned. Critically, though, their most recent quarter, Q1 2025, ending June 30th, showed a significant year-over-year revenue decline, down to $3.22 million.
A decline. Why?
Management attributed it to retooling for the Black Widow production. Essentially, they paused revenue generation to prepare for that big Army contract, which, okay, makes sense strategically, but it puts immense pressure on them now to ramp up manufacturing flawlessly and execute on that contract. No more excuses.
Yeah, and profitability seems to be the elephant in the room here, right? We're talking about a company basically burning cash to grow.
Absolutely. They are deeply unprofitable. That's a direct result of investing so heavily in growth before the big revenues kick in. For the most recent quarter, their gross margin was 11.6%. Pretty slim already. But after operating expenses, they posted an operating loss of $12.65 million. That's a stunning negative 392% operating margin.
Minus 392.
Yeah. Net margin was equally stark, negative 412%. This classic cash burn reflects that heavy investment. Unsurprisingly, consistently negative free cash flow. They used $12.90 million just in operating activities last quarter, which means they have to rely on external financing to keep the lights on and fuel operations. It's like having a supercar with a huge fuel tank, but no clear gas station in sight for consistent refueling yet.
Okay, so burning cash, but they have managed to raise capital. Given all that, how financially stable are they? Are they going bankrupt tomorrow? And how else do we even begin to value a company operating at this kind of extreme?
Right. Well, they have no history of consistent earnings, just growing net losses. So forget a traditional PE ratio. But on the stability front, their debt-to-equity ratio is actually pretty low, 0.27, meaning they've mostly used equity, stock sales, not debt, to finance growth. That's less risky in the short term.
Okay.
And their current ratio is very strong, 3.80. Thanks to those recent capital raises, they have about $65.9 million in cash. So that gives them a healthy cushion, a decent runway to meet short-term obligations, for now.
Right, but valuation.
Yeah, valuation. Negative earnings make PE meaningless. Their price-to-sales ratio, PS, is roughly 66 times, based on $16.5 million in trailing 12-month sales.
66 times sales. That sounds high.
It's extremely high. Compare that to a more established competitor like AeroVironment, their PS is around 11.4x. So RedCat's 66x signals enormous market expectations for future growth. The market is essentially pricing in flawless execution, perfect performance, trying to build a discounted cash flow, a DCF model for RedCat. It's highly speculative, entirely dependent on aggressive assumptions about future profitability, future growth. And you'd need a really high discount rate, maybe 15–20%, just to reflect the massive risk involved. It's more of an educated guess than a precise calculation at this point.
Market dynamics and future outlook.
Okay, with that core foundation laid, the business, the management, the tricky financials, let's zoom back out. Look at the broader market and future prospects.
Right. Next up, we have Chapter 4, Market Sentiment.
So what's Wall Street saying about all this, especially with such a polarized financial picture? And how does breaking news, like that NATO thing or the lawsuit, affect the stock price day to day?
Well, analysts are actually decidedly bullish. The consensus is buy or strong bow.
Yeah.
Average price targets are hovering around $15 to $16, which, suggests 36–45% upside from the current $11 price. But the narrative overall is highly polarized. It's a classic battleground stock. On the bullish side, you have that recent NATO NSPA catalog approval just this month sent the stock soaring, seen as massive validation, key to international sales.
Right.
But on the bearish side, you have the class action lawsuit. The short seller reports alleging misrepresentation. Those have caused sharp drops in the stock price. It's just this constant tug of war between hope and skepticism in the market.
That really sounds like a battleground. What do the technical indicators, beyond just analyst ratings, tell us about investor mood?
Yeah, digging into the technicals, a significant red flag is the exceptionally high short interest. It's at 21.26% of the float.
Wow, over 21%.
Yeah, that indicates deep market skepticism. A substantial chunk of the market is actively betting against the company. However, the stock is trading strongly above its 50-day moving average, which is around 8.95 and its 200-day moving average, sort of $7.23 to $7.99 range. It's currently $11. But that's just a powerful recent uptrend.
So high shorts, but rising price.
Exactly. It creates this really volatile setup. You've got a large pool of potential sellers ready to jump if negative news hits, but also a massive opportunity for an explosive short squeeze if positive catalysts continue and the shorts are forced to cover. It's a real high-wire act.
Fascinating dynamic. Now let's consider who actually holds the reins, or at least a significant stake, in this company.
Okay, that brings us to Chapter 5. Ownership structure.
Who actually owns a piece of RCAT? And what does that ownership structure tell us about its perceived risk and maybe its potential?
Well, institutional ownership is relatively low, around 29.1% to 32%, mostly the passive giants, BlackRock, Vanguard. Though they did see significant buying increases in Q2 2025, which is interesting.
Okay.
Insiders hold a substantial chunk, 15% to 17%. CEO Jeffrey Thompson personally has over $110 million invested. That usually aligns interests pretty well.
You'd think so.
You would. However, there's a definite cautionary tale here. Over the last 12 months, there have been 32 insider sell transactions versus only one open market buy.
32 sells versus one buy.
Yeah. That overwhelming selling pressure, even from the CEO, it's a significant red flag. You just can't ignore it. It suggests maybe those closest to the company are hedging their bets somewhat.
So if institutions are relatively light and insiders are selling more than buying, who's really in charge here? And how does that influence the stock's behavior?
Ownership is actually quite diffuse. The general public retail investors holds about 53% of the shares.
Over half. Wow.
Yeah, which makes the stock highly susceptible to narrative-driven trading, social media sentiment. It certainly contributes to its volatility.
Makes sense.
It also suggests many large institutional investors are still kind of waiting on the sidelines, maybe waiting for more concrete financial performance before taking substantial positions. When retail holds such a large portion, the stock can be incredibly reactive to news, both good and bad. Those wild swings become more common.
Okay, with all this complexity, the tech, the financials, the market sentiment, the ownership, it's time to try and boil it down. A clear picture of RCAT's strengths, weaknesses, opportunities, and threats.
Absolutely. That brings us to Chapter 6, Risk Assessment, SWOT Analysis. All right, starting with strengths. RCAT's biggest strengths include its strategic market positioning within that U.S. defense sector, offering NDAA-compliant, U.S.-made blue UAS-listed drones. That's huge.
Right, that protected market.
Exactly. Backed by third-party technological validation, that Army SRR contract win, the NATO NSPA approval, gives them immense credibility. They have an expanding and differentiated product portfolio focused on all-domain operations, and that dominate the night capability. And, importantly right now, strong financial liquidity from those recent capital raises provides a crucial cushion during this high-growth, high-burn phase.
But every company, especially one making such high-stakes bets, has its Achilles heel. What are RCAT's most critical weaknesses, the things that could really trip them up?
Yeah, the weaknesses are significant. Number one, Lack of profitability and high cash burn, with no clear timeline to actually making money. That's the elephant in the room.
Keeps coming up, yeah.
It does. Then there's unproven manufacturing at scale. The lawsuits directly question their ability to meet the high-volume demands for that crucial SRR contract. Can they actually build enough drones fast enough? They also face extreme customer concentration. Right now, it's heavily reliant on the U.S. Army. If that relationship shifts for any reason, they're vulnerable. And finally, that history of shareholder dilution to fund growth, which, frankly, is likely to continue as long as they remain unprofitable.
Okay, so significant weaknesses. But looking ahead, beyond the current challenges, what are the big opportunities? Things they could potentially seize that might propel them into a completely different league?
Well, the massive and growing addressable market for both military and commercial drones is just a huge tailwind.
The market itself is growing fast.
Incredibly fast. Then there's the potential ban on Chinese drones, like DJI. If that happens, it could create a multi-billion-dollar vacuum. One that RCAT, being US-made and NDAA compliant, is perfectly positioned to help fill. Maybe overnight.
Game changer.
Potentially. International sales expansion via that NATO NSPA catalog is another big one. Access to 32 allied markets. And don't forget the regulatory tailwinds for commercial drones, with the FAA's BVLOS rules potentially opening up all sorts of new applications and markets. It's really a target-rich environment for them if they can navigate the challenges.
And what about the dangers lurking outside their control? The threats that could derail even the most promising plans?
Threats are definitely there. Intense and well-funded competition from established defense giants, plus those nimble private tech firms like Skydio, they face significant legal and reputational risk from that ongoing class action lawsuit. A negative outcome could seriously impact their credibility, maybe even their financial standing.
Right, that lawsuit is key.
Absolutely. Their fortunes are also tied to government budgets. Any shifts in defense spending or political priorities could make them vulnerable. And probably the single greatest threat is just pure execution risk. Can they successfully transition from R&D to mass production? Can they meet contract timelines? That's a billion-dollar question.
Everything hinges on that.
Pretty much. Then you have macroeconomic threats, inflation pressuring margins, high interest rates making future financing more expensive, more dilutive. Geopolitically, while tariffs on Chinese drones could be a net positive, tariffs on imported components could actually increase their costs, squeezing those already thin margins. Lots to watch out for.
Wow. This has been a whirlwind of information. It really reveals a company that seems to stand at a major crossroads.
For sure. And that brings us neatly to our Chapter 7, Conclusion.
So what does this all mean for RCAT Holdings? It really sounds like a company with two very different paths ahead, almost diametrically opposed possibilities.
Indeed. It's honestly one of the most polarized investment cases I've seen recently. Very little room for a middle ground here. The bull case sees RCAT as strategically brilliant, perfectly positioned, aligning with geopolitical shifts, U.S. regulations, military doctrine.
You're ticking all the right boxes.
Exactly. The technology is validated.
Mm.
Army SRR contract, Blue UAS list, NATO catalog. That provides immense credibility. With a strong balance sheet, that cash cushion, bulls see a massive growth runway in a rapidly expanding market. The bear case, however, highlights profound execution risk and, frankly, credibility issues. Deep unprofitability, negative cash flow, unproven manufacturing scale, and evaluation. That's 66 times price to sales. That is priced for absolute flawless execution. There's zero margin for error built in.
None.
None. Add to that the serious lawsuit allegations, the consistent insider selling. It fuels skepticism. It suggests the exciting narrative is at real risk of colliding with some harsh operational realities.
Given this intense tug of war between the bulls and the bears, how do we even begin to think about its valuation? Is it all just a hopeful guess at this point?
Assigning a precise intrinsic value today, it's highly speculative. Any DCF model, as we discussed, depends entirely on really aggressive assumptions about their transition to profitability, their ability to scale production. The range of potential outcomes is exceptionally wide. Successful execution, meeting those contract demands, that could justify a much higher share price. But failures, further legal setbacks, that could imply a much lower one, could severely impact its market cap. The current valuation, plain and simple, reflects belief in future potential, not present financial performance. It's purely a bet on what could be.
So RCAT Holdings, at $11 a share as of September 12, 2025, it really is a high-stakes play. What should you, our listener, take away from this complex unfolding story?
It's a high-risk, high-reward proposition, period. The current market cap reflects significant optimism, maybe even, some exuberance. An investment in RCAT today is a speculative venture. It's a bet on management's ability to navigate immense operational hurdles, overcome serious legal challenges, and successfully transition from basically an R&D outfit to a reliable, large-scale defense manufacturer. The chasm between the bull case and the bear case is just vast. And the operational results, the actual production numbers coming out, the legal developments over the coming quarters, it will be absolutely critical in determining which narrative ultimately prevails. It is definitely not for the faint of heart.
So, will Red Cat Holdings truly dominate the night and the future of unmanned warfare, soaring to new heights? Or will the weight of its challenges, the fierce competition, prove too heavy to bear, bringing it crashing back to Earth? That's something for you to consider as this story continues to unfold. We really hope this deep dive has given you a clearer, maybe more nuanced picture of Red Cat Holdings. If you enjoyed this, please remember to like and subscribe to the Stock Analytics AI YouTube channel. Members get to add stock suggestions for future videos, and we do pick them up. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access. It's a fantastic way to get priority deep dives into the tickers you care about most.
And just a final important reminder, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us for the deep dive.